Have you ever wondered how to invest in ETFs using dollar cost averaging? Let's break it down. ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product. They're traded on stock exchanges, much like individual company stocks. But here's the kicker. ETFs hold a blend of assets such as stocks, commodities, or bonds. This means when you buy a share of an ETF, you're buying a small piece of all these assets, not just one company's stock. The value of an ETF share fluctuates throughout the trading day, trading close to its net asset value. Think of ETFs as a basket of different investments. This basket approach offers you a chance to diversify your investments across a broad spectrum of assets. So, ETFs allow you to diversify your investments. But how do you start investing in them? Enter dollar cost averaging. Now you might be wondering, what is dollar cost averaging? Well, let's delve into it. Imagine you've set your sights on a specific investment, say an exchange-traded fund or ETF. Instead of investing a large sum all at once, you decide to split that amount into smaller, regular investments. This is the essence of dollar cost averaging. Picture it like this. You're at a fruit market. Instead of buying all your apples in one go, you decide to buy a few each week over several weeks. This way, sometimes you might buy when the price is high, other times when it's low. But overall, you're aiming for a steady average price per apple. Now, apply the same principle to investing. With dollar cost averaging, you invest a fixed dollar amount in your chosen ETF at regular intervals, regardless of its price. This could be weekly, monthly, or quarterly. The point is consistency. So why do this? Well, the beauty of dollar cost averaging is that it helps reduce the impact of market volatility. You see, markets can be unpredictable, swinging up and down like a kangaroo on a trampoline. But with dollar cost averaging, you're not trying to time the market or predict its highs and lows. Instead, you're sticking to a set plan, which can make investing less stressful and more manageable. With dollar cost averaging, you can mitigate risk and potentially grow your investments over time. So, are you ready to hop into the world of ETF investing? So, how do you invest in ETFs using dollar cost averaging? Well, let's dive right into it. The first step is to choose the right ETF. This involves doing some research. Look at the ETF's holdings, performance history, and expense ratio. You want an ETF that aligns with your investment goals and risk tolerance. Remember, not all ETFs are created equal. Some are designed for aggressive growth, while others are more conservative. Once you've chosen your ETF, the next step is to decide on the investment amount. This is the money you're willing to invest in the ETF at regular intervals, regardless of the price. It could be as little as $50 a month or as much as a few $1,000s, depending on your financial situation. The key here is consistency. You want to invest the same amount every time, regardless of whether the price of the ETF is up or down. Next, you need to set a regular investment schedule. This could be monthly, quarterly, or even yearly. Again, the emphasis is on regularity and consistency. By investing at regular intervals, you're practicing dollar cost averaging. This strategy can help you avoid the pitfalls of market timing and reduce the impact of market volatility on your investments. Now, it's time to execute the plan. This involves actually buying the ETF at the predefined intervals and investment amounts. You can do this manually each time, or you can set up automatic purchases through your broker. Automatic purchases can be a great way to ensure you stick to your plan and maintain consistency. Finally, it's important to review and adjust your plan as necessary. Market conditions change, and so do your financial circumstances. Regular reviews will help you stay on track and adjust your strategy as needed. And there you have it. Investing in ETFs using dollar cost averaging is a strategy that can help you build your investment portfolio. It's a method that encourages discipline, reduces the risk of making poor investment decisions based on market fluctuations, and allows you to take advantage of the market's ups and downs over time. So why not give it a try? So let's quickly recap what we've learned today. We've explored the world of ETF investing and the power of dollar cost averaging. This approach provides diversification, spreading your investments across a broad range of assets, which can mitigate risk. Moreover, by investing regular amounts over time, you can potentially reap higher returns. It's a strategy that works for many, from beginners to seasoned investors. Remember, investing is a journey, not a destination. And with ETFs and dollar cost averaging, you're well equipped for the ride.